Hey, the yield curve just came out of inversion for the first time in, let's see, yeah, we had a brief re-steepening here on August 5th, but it never closed above this level. And now it's finally closing above this level for the first time since the 5th of July, which is 794 days of inversion. This marks the longest inversion in the yield curve in history. Uh, Let me do this just so it's not orange. And if we're going to look again, if we overlay the unemployment rate, this means that the unemployment rate is going to continue going up. Now you might look at this and you might say, oh, but it came down this month from 4.3 to 4.2. Yeah, from 4.25 to 4.22. But U6, which is the real unemployment rate, again, it's the way it was calculated before they changed it in 1994. This is the real unemployment rate, and this keeps rising. This is up from 6.5 at the cycle low. Last month it went from, well, the previous report before this one we got today went from 7.4 to 7.8, and then it went up another 0.1 today. On top of that, we have I actually bookmarked some of these on Twitter. Um, the June and July jobs report were revised lower by an additional 86,000 jobs. This is the second time that the June jobs report was revised lower. So they revised the same number twice down. And of course, it's revisions to the downside pretty much every single time. Not every single time, but pretty much every single time. What else? We have the Canada unemployment rate moving up from 6.4 to 6.6. You might go, well, why should I care about Canada? Because this is going to happen to the US as well. You can see we have a clear trend there as well, where we're clearing an uptrend in unemployment rate. And then we had a market reaction today to something. I might go, so what did the market sell off so much due to today? And you might go, well, you're reading a bit too much into it, why the market is down today. I don't know, that's a pretty brutal reaction right here in one day. Um, and for the people who are arguing that rate cuts are good, this is your rate cuts, by the way. When the 2 year falls, I mean, this is it's the exact same thing as when the Fed funds falls. The Fed funds actually follows the 2 year. Um, and this right here is textbook bull steepening. Again, bull steepening is when the front end of the yield curve, so this, a short-term interest rate, falls faster than the long-term interest rate, in this case, the 10-year. And then if you go to TradingView and you write US 10Y minus US 02Y, you get the 10-year minus the 2-year, and you can see this is the yield curve spread, and it's up massively today, meaning we are now coming out of a inversion that lasted for about 800 days. Nikkei is down about 4.7% today. The Nasdaq is down 2.4% today. S&P is down 1.6%. Bitcoin is down 4%. Ethereum is down 5.5%. So if this is a good thing, meaning interest coming down is a good thing, well then you should expect the stock market to have a good reaction, right? But we know what happens historically during these periods. When the yield curve is inverted, the stock market is normally at the all-time high. In fact, every single time on the whole chart. But when it re-steepens out of inversion in these green zones, which is the US recessions, you can see the stock market sells off, you can see the stock market sells off, you can see the stock market sells off, you can see the stock market sells off right here. And what is it doing right now? Well, it's too early to say if we're crashing like every single other time, but this is what history tells us is coming next, right? So big news today, the yield curve is officially out of inversion for the first time in 800 days. I actually wanted to do some chart analysis because there is some interesting things going on a bunch of charts right now. I haven't done a chart analysis video in a long time. Now, the way I view this is we have equal lows right here on Ethereum, and this is going to affect the altcoin market as well. And I think the closer we get to this, the more fragile this gets, and this could go down towards, I don't know exactly, but I think we're gonna have a decent flush here. This is what happened last time we built equal lows right here. and then we flushed. And in this case, we flushed by about 25%. Now, is that going to happen this time? I don't know about that, but I think going down to 1800, yeah, for sure, seems very reasonable. On BTC, we have something relatively similar. Um, Actually, we already swept this level, and I'm not convinced that this is um, the point where we flush way lower. Although if you just look at it from higher time frames, mm, it's still more probable that we make a lower low here, maybe into the mid 40s. Let's say like 44k or so, right, where we had a lot of trading volume in the past, between like 42 to 44 or so. But everything depends on the stock market, really. So you remember I was showing you this fractal, right, on the Nasdaq, and this is taken from 2006 to 2009, this orange line. And we can just go back and look at what the structure looked like back then. It looked like this, right? And that is exactly what we have today. It quite literally mirrors it perfectly. Yeah. Now it's gonna deviate at some point. I would not trust a fractal forever, but the general path is what's interesting. If this plays out, we go down about 70% in Nasdaq. If you think that's impossible, we went down 84% in the dot-com bubble. So what about the S&P 500? Well, it's also following what it did in 2006, 7, 8, and 9. And the interesting thing about the S&P right there is that, again, this is aligning with the rate cut dates. Back then we cut rates on September 18, 2007, and we're doing that again now on September 18th, 2024. As the unemployment rate is rising, and as we know, as the yield curve is re-steepening through a bull steepener, just like over here, re-steepening through a bull steepener. And another thing that's interesting here is it's too early to tell if we're going for round two on the Nikkei, but we built up. We have lots of invalidations here, just like on Ethereum, where right here we have equal lows. You can see it's people sharing the same invalidation, and so they're likely to have their invalidation get hit. And it's on top of these previous highs right here. And these candles are starting to look something like what we experienced over here. And again, back in 2007, then it came at a lower high. It's doing that today as well. If we just go look at the 2-year, we have equal lows here as well in a 750-day sideways period, just like back here during the GFC. If this loads, I think it's because I have this on. We went sideways here for about 750 days, and then we started falling here, and that was not good. That was the beginning of the GFC. Just like I think we're going to start to fall off of a cliff in the 2-year yield, which is going to lead to more bull steepening, and then you got your recession. And right around here is where the S&P 500 started to react very negatively. If you just look at this right here, this is where it started to sell off when this portion of the 2-year yield moving down started to occur. And are we getting the same thing now? I think we are, but we'll have to wait and see. You have the same thing over here. When a 2-year falls too much, then it's very bad. What else? I think that's pretty much everything that I wanted to go over in this one. I'm gonna try and keep this one brief for now. But yeah, pay attention to the 2-year yield. If we keep seeing bull steepening, if this loads, if we keep seeing bull steepening, then that's likely a huge warning sign for the markets, because falling interest rates is the opposite of growth and inflationary expectations. It's actually a sign that the economy is really, really weak. If you think that the unemployment rate is going to stop rising, uh, again, this is where I think it's going, just because they cut rates, yeah? If you think that that's where it's going, then let me remind you of what's happened in the past when they've cut rates. They cut rates right here, the unemployment rate is just moonstaring it. They cut rates right here, the unemployment rate is just moonstaring it. They're going to be cutting rates here. I think it's just going to moon during it. But yeah, that's pretty much everything for this one. Take care, peace.